you say that you all are a little bit underweight equities in your portfolios. One of the things that makes you suspicious is that so much of the market momentum seems to come from 5 mega cap stocks. But you also say that to the extent that you are interested in equities, you are interested in overseas equities, particularly emerging market equities. Tell me about why you're underweight, why you're concerned about the big caps in the U.S., and why you like emerging markets.
Well, thanks, Tyler. So number one, our underweight's a slight underweight. It's not a massive underweight, but we do think that in the short term, the markets have the potential of grinding higher from here. But it's really about the makeup of the market right now. As Bob Pisani mentioned, that it's the top 5 stocks that have been leading the way. So our view is the FAANG 5 are probably enjoying their last dance as the leadership of this market environment that we've been in for a long time. And the regime change is coming very soon. And so the concentrated names are the bigger risk. Now, that can lead the overall market down when they do start correcting and we see that rotation. But yesterday was a great example of how you could see a market still doing well, but that rotation really benefiting the underperformers that have been there for late. So regime change is generally a longer process, and I think we are in the beginnings of that regime change of leadership in the marketplace. With regards to the overweight to emerging markets, that's really being driven by our focus from a fundamental relative value perspective, where our relative value model is telling us, hey, emerging markets are really cheap on a longer-term basis. And when you look at the 2000s or the 1980s, emerging markets had a really good run-up in those environments, and those markets can last for a multi-year cycle. Mm-hmm. We are tempering that a little bit with our short-term model that's saying, okay, but the earnings quality is a little bit dampening there. So it's not a full overweight. Once we start to see a much improved earnings picture coming out of emerging markets, which we think in this new environment of governments providing stimulus across the world, is going to create that consensus, and EM is going to take off.
Well, you heard, Jeff, you heard Wasif's comments there on emerging markets and why it is a kind of a tiptoe in kind of approach. But you still like as between U.S. and non-U.S. stocks, you like the U.S. Why?
I do. Well, I think it just goes back to the idea of being focused on risk management at this time. And I think there are wonderful U.S.-based stocks that have very strong balance sheets, have good dividend yield support in here, and catalysts to really visibly drive some growth here going forward. And I think it's just a little early to have a large position in emerging markets where fundamentals, I think, are a little more stressed. They're more commodity-based, and there are just, I think, some more difficult issues to deal with at this time in this 2 to 6 month curve. So we have a blend of offense and defense. We like growth and value, probably tilted a little more towards growth, and just find marvelous opportunities in U.S. stocks at this point where you can be well positioned for this recovery longer out into 2021.